Him's House, episode 24. I'm Jonathan Stern. I'm here with Patrick Lester, who goes by the name Bayside in the Him's House Discord. Today, we are also joined by Alex Beinfield, the founder of Blue Duck Capital, hedge fund based in Southern California. I want to start with a bit of background on Blue Duck, and I'll read straight from the website because I thought this was so interesting. Blue Duck's diligence process tends to underweight traditional sell-side broker research and mainstream financial media, and instead makes heavy use of primary sources. This tends to produce a return stream that has a low correlation with the S&P 500. Now, more to the point of why we invited Alex, Blue Duck first popped onto my radar in December 2024 after Alex published a presentation called MAHA, Will Be Great for HIMSS. That's Make America Healthy Again, Will Be Great for HIMSS. Alex has been interested in HIMSS since the SPAC days, so going back to 2020, late 2020, and we're excited to hear his perspective on what's so compelling about the business today. Alex, welcome to HIMSS House.
Yeah. Hey, Jonathan. Hey, Patrick. Thank you for having me. I appreciate it.
Well, this is one hell of a day to have you on the show. As we were just saying, it's April 9th, 2:07 p.m. Eastern time. Less than an hour ago, we got some news from Donald Trump's Truth Social account. Let's run I want to give a quick backstory on what's been going on. Most of our viewers likely know, but I'll run through it quickly. We're dealing with a relatively unprecedented macroeconomic situation, to say the least. Last week in the Rose Garden, Trump announced tariffs against virtually every country on earth. Since then, markets in absolute turmoil. Last night, Trump levied 104% tariffs against China. Supposedly, there are tariffs specifically targeting the pharmaceutical industry coming soon. Today, again, less than an hour ago, around 1:15 p.m. Eastern time, Trump declared a 90-day pause on all tariffs. Ackman has been calling for this for days, except for China, for whom he raised the rate to 125%. Other countries are subject to a so-called reciprocal 10%. Alex, I'll stop talking. What do you make of all this? And then if you're open to doing a little forecasting, would love to hear, what do you think happens next?
Yeah, sure. So I think that I'm not going out on a limb if I were to say that the tariffs quoted by Trump on April 2nd came in much more aggressive than I think anyone really thought he would come in with. There was an element of shock and awe there, which we know is a tactic that Trump has deployed in the past when it comes to negotiating. The problem with shock and awe is that when you're dealing with the global interconnecting markets and economies is that it can be difficult to put the genie back in the bottle, once chaos inevitably ensues, right? And there are always going to be second order, third order, fourth order knock-on effects from any kind of major policy escalation like we've seen. And I think those second order effects coupled with, as we've seen with, for instance, right, the treasury market not cooperating, I think that's been a surprise and problematic. But those second order effects coupled with what's been until maybe a half an hour ago, total lack of any visibility, timeline, real clarity on the underlying motives here from Trump. I think that uncertainty, right, with the risk that the longer it drags on, more damage is going to occur and more dominoes are going to fall. I think that right there is what really, is going to explain the incredible selling we've had in the market, and justified, if you ask me. Markets hate uncertainty, and that's exactly what we've had. We've been in a completely opaque environment, and all we've had to go on is what we think we know about Trump and his tendencies and his motives, and so I've attempted to make the logical connection here that the incentive for him to get a deal done is very much there, right? Because if the longer it drags out, the impact on the markets and economy would become more and more self-fulfilling. The genie gets further out of the bottle, and their ability to sort of control the chaos, I think, goes out the window, right? And not only that, but in my view, when you're talking about, 104% tariffs on goods from China, I don't really view that as inflationary. I actually just view that as recessionary, because I don't think that we're going to trade with China to import goods marked up 2x, right? And so there's not going to be a consumer market for those goods. And, the importers, the companies that are buying those goods, manufacturing those goods, and then importing them stateside, they're not going to have any appetite to do that either, because they know that they have to pass it on to the consumer, and the consumer's not going to transact at those prices, right? So I've been kind of the view that the inflationary risks here have probably been overstated, but that the recessionary risk has probably been understated. And all that is to say now, right? I mean, we just got a big development. It looks like he is going to delay the worst of the tariffs, 90 days, for all the companies that look to be negotiating in good faith with us. I think that's wonderful development. I think was absolutely essential that they make that announcement ASAP. I was of the view that some sort of deal like that or announcement like that needed to come from the administration, and it needed to come quickly. Because again, the longer this the uncertainty were to drag out, the more damage would be done, the harder it would be to repair that damage. And by the way, it hasn't really looked like the Fed has had any interest in really engaging yet either. So it's not like, I don't think the Fed has really had Trump's back in all this, which is notable, I guess. So in any event, I view today's development of sort of isolating China, right? They increased the tariffs on China to the point where it does put China it's very problematic for them. They're the biggest exporter in the world. And at the same time, making sort of a grand overture to everybody else to say, hey, we're open to talk. Let's talk. In the meantime, here's a pause. So that's all very constructive, and the market is responding like I would expect it to respond, up quite a bit. Up, the Nasdaq's up about 10% right now. So I was glad that happened today. It makes my job a little easier, because I don't just short stocks. I do a lot of shorting, but been leaning a little more bullish, and it's good for HIMS, right? Which I actually added to this morning. So
I do want to move the conversation to HIMS soon. I guess just to piggyback off what you were saying about the recession, I mean, we did get news this morning that Amazon is canceling some inventory orders from China following the tariffs taking effect. Will be interesting to see what they do. I mean, the tariffs are still in effect, and they've been raised against China now to 125%. So my hunch is that there will be more cancellations for as long as greater than 100% tariffs are in effect, but we'll have to see. And that certainly does sound awfully recessionary. Moving to HIMS, though, there are going to be some specifically targeted pharmaceutical tariffs, supposedly, but just zooming out in a chaotic macro environment, suppose there is a downturn, whether it's this year or 4 years from now or 10 years from now. How does HIMS perform in that sort of environment, Alex?
I think they perform fine. I think that a lot of their products are staples, for people that hair loss or, erectile issues or heart, cholesterol issues. Those the treatments that HIMS offers on their platform for those things are very much in the staple category. I think non-negotiable for a lot of folks are, regulars on the HIMS platform, subscribers. So, maybe you could put the GLP-1 bucket in a little bit of a different category, a little bit more of a discretionary category. But to me, that could be more of a negative for for the Eli Lillys, the Novo Nordisks, where they have the higher price point, and at the same time, drive more share to the compounded versions, which come in at that lower price point. The other thing that I think is sort of interesting about, and I think Dunham talked about, he mentioned that on the podcast with you guys, right? He didn't really. I think he talked about the cream rising to the top, and it's true. I think when you're a market share leader and a first mover or a very early mover, and you have more scale than your competitors, it is a strategic advantage in a market downturn. I think, Walmart came out today and they said they sounded emboldened, encouraged, excited about the opportunity before them with regard to the tariffs, because they think they're going to take share, and meaningful share, I think they indicated. And so meaningful share for a company like Walmart would indicate that they're about to crush a lot of small businesses, right, on the retail side. And that's not exactly analogous to Hims because it's a different animal, but I do think that their market leadership, their well-capitalized balance sheet, the fact that they generate cash, all of it, right, it positions them much better to sustain, survive, and ultimately thrive through any type of downturn, because I think that their overall market position would only get better because they're the leader, and et cetera, et cetera. So I don't want a recession to ensue, and we would obviously expect the stock to go down, but I would think that ultimately Hims would come out better for it on the other end, much like Amazon did, by the way, back in, the early 2000s when the dot-com bubble burst. Jeff Bezos talks about how every day his stock would go down more every day goes down, and yet he's looking at all these metrics, KPIs, right, internally, and each day they're getting better for Amazon. So in instances like this, you want to be the market share leader. You want to be the bigger player, the better capitalized player. And I would definitely put Hims in that category within this sort of emerging space of, online medicine.
Patrick, did you have a follow-up there?
Not on that particular topic.
Great. Just one more thing about your background, Alex, before we move on. I mean, I really was intrigued by what you said on the website about being sort of averse to traditional sell-side research. It's just rare, I think, that you hear a hedge funder say outright, we don't look at what the sell-siders are saying. We underweight that sort of thing. Can you say a little bit more about how that influences your process at Blue Duck?
Yeah, absolutely. So I think, I started my career at, two relatively marquee hedge funds, one of them probably very prominent. And part of our process there, for me, I started as a junior analyst, kind of worked my way up to become a bit more senior. But a big part of the process there was, at that fund, we had a lot of scale, right? We paid the street millions upon millions at, every year. I mean, I don't even know how much, but like a ton of money every year. And with that, you get basically infinite access to the sell side. And so that means, what does that mean? It means that I could call up, even as a junior analyst, I could call up almost any analyst and probably get them on the phone relatively quickly. I could definitely get their junior associate on the phone. We could get any meeting we wanted with them. We would get early access to, corporate access, that type of thing. We would have the sales guy calling us and summarizing the key research notes every morning. So it's very much a model that I think relies on the sell side. I wouldn't say rely, but uses the sell side as a tool to gain any sort of incremental edge that might be found from interacting with them. I think that's sort of very much what sort of the original pod model was, kind of pioneered by Steve Cohen. Over the years, right, as more and more capital accrued to these mega multi-strat hedge funds, and more teams were deploying similar strategies, right? The alpha captured from that constant interaction with the sell side becomes diluted over time, right? And it's like with any model or investment process, the more investors that begin to adopt it, the less alpha it's going to produce. And so for me, when I launched my fund in September 2020, I was very small. We were infantile relative to, in terms of size, relative to the big boys. And I don't generate enough commissions to have all you can eat access to the sell side. So I needed to kind of adopt and figure out ways to develop edge without them. So I think part of that process, right, it was by necessity, but then I started to kind of realize that, well, maybe I don't, we started to do pretty well, right? Just by looking at everything directly ourselves, relying on building our own tools to track data. I think for me, I get a lot out of interacting with management directly. I prefer to, ideally meet them in person, but nowadays you can Zoom everything, so that's almost as good. That part of it, that direct interaction with the source material, call it, right? You just get you get more signal and you get less noise, right? You're not playing a game of telephone. You're not relying on he said, she said, nor do you run the risk of potentially subjective takes, right? Which is what you will often get from the sell side, who I think in many cases are going to have a little bit of an agenda, right? And so for me, that sort of going to the source directly, I just found it to be simpler, cleaner, less convoluted. And also, frankly, and to be clear, it's not like the big hedge funds aren't doing that too, right? They're talking to the sell side and they're talking directly to management. But for me, I felt like I could end. It's almost like blocking out a lot of noise from the sell side and then focusing directly on the source material and simplifying that entire process. And I found it to be productive. So that's kind of where that comes from. Maybe not coincidentally, I don't know, but our return stream has been fairly uncorrelated, which could be a byproduct of that. And then the other thing I would mention too is, and this is more true before COVID, it's like 98% of the hedge fund industry was centered in New York City, right? And maybe a little bit in Connecticut. And you just get a lot of groupthink because everybody goes to the same meetings, everybody talks to the same analyst, everybody gets the same incremental data point from the same sales guy, right? And so if everyone's getting the same information at the same time, which is sort of what that model became, then I don't know how you really develop much edge relative to your peers. And so that's, I think, why we felt like we needed to do it a little bit differently. First out of necessity, then increasingly because we've gained a lot of value from it.
Well, Warren has always said there's value to being in Omaha. So
Exactly.
I think that makes a lot of sense, Alex. I'll turn it over to Patrick for a couple questions that are more HIMSS related.
Although I have to say, I think it sounds like more people are headed to Florida than Omaha these days. Let's shift the conversation directly to HIMSS, as Jonathan just said, and specifically some of your history. Now I have to confess, I stole this question from Jonathan, who knows a little bit more about your background than I do. But I want to think about it in 3 different phases. So the first phase, in the early days, I understand you first took an interest in HIMSS, I think back in late 2020 during the SPAC days. And then later on, my understanding is you've kind of been in and out in HIMSS over the years. And like, what were you thinking then? And then just bring us to today. What are you thinking today? What are you thinking? How does that, what your current strategies are, how does that mesh with what you may have learned from those past phases?
Yeah. So HIMSS landed on my radar back in, I think, 2021 or 2020. I forget. But, relatively recent de-SPAC at the time. And We run screens for insider buying, and we found that David Wells, a board member and the former CFO of Netflix, first of all, we didn't know he was on the HIMSS board, but we saw the insider buy, and I happen to know David Wells very well from my history covering Netflix since 2012. So I've had high regard for him. I think he made a couple $1 million type purchase at the time, and not nothing money, right? I think not all insider buys are created equal. I would say some are definitely of the token variety, right? Which is when a CEO or somebody may buy $50,000 worth or something like that, which is typically not much relative to their net worth. But in this case, it was couple $1 million type purchase, and I think for anybody, I don't care how rich you are, that's not nothing. And so because of that, the name landed on my radar. I started to look at it, saw what they were doing, saw the aspiration from the company to increasingly grow more vertically integrated, and which reminds me of Amazon, by the way, and Netflix. But then also, I think, realized that, well, they're already, this big and growing, and they're only in like 3 or 4 categories, right? Of terms of verticals of healthcare, hair loss, ED, stuff like that, like kind of the basics, right? And why can't they just keep adding categories and verticals just like Amazon did? And if that's the case, right, and they actually are striving to solve a major pain point, right, which I think is, again, analogous to what Netflix did, what Amazon did, what Spotify did. And you could make the argument that the pain point in healthcare, right, pain point being how horrible our healthcare system is, right? It's expensive. The pricing is completely opaque. You're getting ripped off by the insurance company. You're getting often ripped off by even your doctor. It's not uncommon. You can get ripped off by the hospital because they're getting ripped off by the insurance company. So everything, none of it is good for the consumer. And, oh, by the way, the entire process, even for the most basic, easy to solve things, is friction filled. You got to go to the office. You got to wait in the little room. You got to fill out a bunch of paperwork. You then see the doctor for maybe 10 minutes. They prescribe something. You got to go to the pharmacy. You got to pick it up. It's just kind of a pain in the neck, right? And I would say just completely full of friction and a major pain point. So to backtrack, what other businesses had major pain points, right? Well, I wouldn't even call them major, but they were pain points. Amazon, what did they solve for? They just made buying stuff a lot easier. And they started with books. They eventually moved on to all kinds of media and then apparel, et cetera, and now they sell everything. But they solved the pain point. They made it easier for people to buy stuff online, and they made it really efficient, and they got really good at it. But the pain point in healthcare is much bigger than that, right? It's not that annoying to go to the bookstore, right? It's not that annoying to go shopping for clothes at a store, right? Some people even prefer that. But in healthcare, I don't know anybody that necessarily prefers dealing with the nightmare that is going to the doctor's office or a hospital or a clinic and getting, treatment for stuff and dealing with the insurance company and all that. So at an early stage, I kind of thought that the bigger the pain point, the bigger the opportunity. And the analogy holds that this company very much looks like these other companies that solve for pain points, but in this case, the pain point's even bigger, right? So that's what got me excited about it. And I'll stop there.
I think you've been in and out of the stock over the last 4 years. I think you mentioned to me sort of in a pre-call to this interview that you were out of the stock for a decent portion of 2024, but towards the back half of the year decided to reinitiate a position. Could you talk us through what got you excited towards the end of last year?
Sure. So I think for us, a big part of our process is we like to think in themes. And I wouldn't say that drives everything that we do in the book, and nor does it drive every idea that gets in the book, but it's just a good way to kind of think about the world and, kind of create a mental map, if you will, of the different trends that are going to be investable. And one theme that we felt like would gain traction, and we had this thought during the summer of 2024, was that if Trump won the election, our tea leaves were telling us that RFK was going to have a major role in the administration, and that, his so-called MAHA, Make America Healthy Again initiative would potentially be a good thing for HIMSS. And not necessarily because of any obvious glaring reason, but more because the enemy of my enemy is my friend, right? In this case, right, who does RFK Jr. staunchly oppose, right, in a lot of ways, in a lot of ideologically and so forth, and economically, and I think who does he stands against Big Pharma and the entire status quo of healthcare, right? He has come out and said that the healthcare system, the way it works today in the country, has completely failed Americans, right? And by doing that, he is declaring himself as essentially an enemy of the status quo and an enemy of all of the entrenched players that fit into that and have played a role in his opinion making America less healthy, right, over time. And we can get into the validity of that perspective. I think there is a lot of validity to it. It's debatable. I know that there's a political element there, but that really doesn't matter. What matters is that if Trump won, which he did, then this guy is going to have major influence over healthcare policy going forward. And guess who else happens to be sort of stand opposed to the status quo in healthcare? HIMSS, right? They're like one of the only companies out there that do it differently. They're trying to solve the pain points. They're trying to bring transparency to healthcare pricing. They're not beholden to the insurance cartel like a lot of other healthcare providers are. And so that sort of epiphany, I guess, caused me to take another look at the name and got back involved, late summer 2024. Because, oh, by the way, they're growing ridiculous growth, right? Profitable already, free cash flow positive. They have a buyback to help offset stock dilution. This doesn't look like any kind of SPAC at all. This looks like a very well-run company with incredible growth runway that already has been growing fast, already profitable, open-ended TAM. So it wasn't that hard, right? Once we identified the theme and bought into that as a theme that should have legs for a number of years, it just became clear that, well, wow, this company looks pretty interesting here, and the valuation wasn't egregious at all. What is it like at the time? 2x revenue for 100% type growth. And so yeah, it wasn't that tough a lift.
So as we sit here early April, we're a few months into the new administration. RFK has been confirmed as head of HHS. We also have Dr. Marty Makary, who has now been confirmed as the new chief of the FDA. How is the regulatory environment tracking versus what you were expecting? Obviously, the focus has been on tariffs and other things thus far, but pharma tariffs specifically are to come. And there's the whole compounding issue with GLP-1s. Basically, is there anything that you can gather so far from what we've seen through the first 3 months that tell you how your thesis is tracking versus what you expected?
Um, I think it's all on track. I would say it's pretty clear that RFK understands, I guess, delicate situation that he's in, standing as an antagonist relative to the entrenched status quo healthcare lobby, which, as we know, is incredibly powerful, donates millions to powerful politicians, just really has the mainstream media at their beck and call, right? I mean, I think in light of that, RFK has been strategic and smart, deliberately but diligently and cautiously moving forward with initiatives, I think, to make America healthy again, right? And it's not, Trump, actually, there's a quote from Trump saying that he may let him go crazy for a while and then he might rein him in, right? Trump made that comment, I think, on the campaign trail when he was campaigning with Bobby. And I wouldn't say that Trump has let him go crazy yet. And I think part of that is because of the delicate nature of it all. And because RFK knows that anything he does from here is going to be under a lot of scrutiny. It's going to get a lot of pushback. He's going to be fighting powerful forces, right? And so he just wants to be deliberate and smart and intelligent about the execution. And I think he also wants to be able to corroborate anything he does with real data and real studies backing it all up. And if you look at one of the first things that came out of the Trump admin post-election and inauguration was his Make America Healthy Again sort of blueprint. And in that, they actually put out some time, a little bit of a timeline for updates on certain studies and certain initiatives that they're going to be looking at. I think I would venture to say that some of those initiatives are going to be looking at things like, the risk reward of taking the COVID vaccine, stuff like that. And, I believe that they are going to do their own work. They're going to do their own analysis, their own research, and they're going to come back with evidence that will bolster any case that they subsequently make for change. And I think that right now that process is ongoing. I believe we're going to get an update in May, and then we should get another update later in the summer from them with more clarity on certain initiatives that they plan to do. But for now, I think it's all good. I mean, I wouldn't take, some people in the Make America Healthy Again movement, if you will, are mad that he hasn't come out and banned the COVID shots or done certain other things that I think a lot of people have been calling for. I would just say be patient. I think they're building a case, and that when they do come out with some major initiatives and rule changes, I think that all of it is going to be supported by a lot of empirical data that they put together. So for me, I think I see no indication that anything is off track here at this point. I think that they're just deliberately went about it, and more to come.
So I had a question. You talked a little bit about Moats a second ago. So let's get into that a little bit, shifting back on the him side. So I have my own opinions about Moats. I won't get into details here because we want to hear what you think, but certainly some of them are the brands. I mean, you're talking about online meds. We've got people with, questionable background. People don't necessarily know the company. So if you're trying to sell anything in the healthcare space, you need to be a trusted brand, and that would be one of them. Another one you kind of alluded to a second ago, and we'll probably dig into that one more. I call it the economies of scale issue. I mean, basically, if you go by observed sales and the Bloomberg data, which I think Hims has done in their earnings report, they've got about half the market when it comes to some of the telehealth specialist companies. I don't think that included Amazon, but even if you look at, say, Google Trends, comparing Amazon to Hims, Hims is 2 to 3 times on any given product that Amazon might be selling in the same space. So although it's not necessarily a huge space, Hims is the big dog and it has an economies of scale advantage. Now, one of the things you mentioned, and I want to get into it here, was this verticalization issue. You must have your own ideas about what a moat might look like. Tell us a little bit about what you think that is.
Yeah, well, I think when you're talking about early mover, first mover, internet-based kind of marketplace type models, right? Where Hims, they have a lot of healthcare providers on the platform providing the clinical care and interacting with the customers, the subscribers. And then they've got these different verticals that they can expand into and add to the platform, increasing their supply. You do that, you increase the appeal, the broad-based market appeal to a wider set of customers. And what that creates is a positive flywheel. It's a network effect. And it's a very powerful dynamic. And we've seen it with all the large cap, well, now they're mega cap, but internet-based companies that have disrupted incumbent models. And once that flywheel gets going, it can be very hard to catch up if you're a second mover or a third mover. And it gets even harder as that first mover starts to generate cash in a self-sustaining way, right? And, but they don't have any debt either. Oh, by the way, let's look at the unit economics, right? Which we think the LTV to CAC on Hims is in the 2.5 range, which is quite good. So they're able to acquire customers at a reasonable price, and the lifetime value of those customers is over 2x what the cost of acquiring. So that's a beautiful thing right there, right? And you always want to, before you can form an opinion on the quality of a moat, you want to make sure that the unit economics are in good shape and sustainable. And with Hims, we certainly think that's the case. So, I've seen over and over and over again in my career instances where Amazon has toyed with the idea of entering a new market altogether, and the impact on incumbents has been de minimis, right? And I'm not saying Amazon has toyed with it. They haven't toyed with it. They've done more than that, right? They've essentially attempted to copy Hims. But I'm not concerned about it because they don't have the branding in it. People don't associate Amazon with healthcare. They just don't. Much like they didn't associate Amazon with music, right? When I remember all this worry a few years back when Amazon, launched all you can eat on demand streaming, that would be this major risk for Spotify and it would be the end of them. And, I think people even said as much about their foray into video content and on Prime Video, and they've made major investments in that. They've made that a major focus. Jeff Bezos has been to the Oscars. That's clearly been a strategic priority of theirs. And yet, has it impacted Netflix at all? No, not really. So I think that it's one thing for them to enter a new market, but it's another thing for them to gain traction with the consumer in that market. And history has shown that that's actually easier said than done, even for Amazon.
I think that's true. Any comments on any of the acquisitions, the 503A or 503B acquisitions, or the new peptide facility? I mean, it seems like it aligns with some of the things you were just saying about those investments.
Yeah, I mean, a couple comments. I think to your point, right? First of all, those assets that they've acquired become strategic assets, right? That some of their competitors maybe can't acquire. They don't have the balance sheet. They can't afford to make such acquisitions. It allows them to get more vertically integrated. So they're going to control more of their costs vertically. And I think, but more than that, right? It tells you the aspirations of where they want this company to be, right? They're not just looking to be a marketplace where they're matching healthcare providers with it, with patience and taking a take rate off of transactions that occur on the platform. They want to be much more than that, right? It speaks to a desire on the part of management to really be a big company someday. And that to me, so I find it all very encouraging because we know how big the opportunity is, right? And we know how big, as I've said before, the pain point is for consumers. And so to the extent that they are dreaming big and thinking big and behaving that way based on the fact that they are taking control of their own supply and strategically potentially making it more difficult for competitors, I think that all just speaks to a long-term plan here, which is to have Hims, as a much bigger company someday. And they're not looking for some exit at $10 billion or something like that. They're not looking to be acquired at a 50% premium here. They're looking, they think this can be a $50 billion, $100 billion company. And that's what that tells me.
Excellent. Jonathan.
Well, I think we've made it close to 45 minutes without really talking about GLP-1s, which for Im's podcast in 2025 may set a record. But I'd like to just touch on it, Alex, which is to say, let's go back to the Dudum interview, where it was probably the top quote that's been shared on Twitter since that interview. GLP-1s are probably the biggest cognitive distraction you could imagine when you're looking at just the core Hims business today, because it's a front page of the New York Times distraction. And he goes on to compare Hims to Amazon and Netflix and say, investors are missing the forest for the trees, which is another theme of the presentation that you gave towards the end of 2024. So the question really is GLP-1 related, but it's related to the forest and the trees as well, which is, what are people getting right about Hims, but also what are people missing about Hims?
Yeah, I
today?
mean, I think you said it, and I said it in my presentation back in the fall. I think that I would caution bears not to miss the forest for the trees here, because, and I'll use Amazon again, not to keep going back to these examples, but I think they're notable. Back in the day, right? Amazon they were first a bookseller, but then they were a media seller, right? They started selling DVDs and, all sorts of entertainment that could be delivered to the home. And say that Warner Brothers or any of the major studios, say they decided that they wanted to build their own direct-to-consumer model, and they were going to stop providing their DVDs to Amazon to sell on the platform. The stock would have gotten crushed, right? Because at the time, DVDs were quite material to what Amazon was doing. And when I say DVDs, I mean, video game, all of it, all forms of physical type entertainment at the time, which still wasn't digital, right? And I think that's the same thing here. You've got all these bears and this wall of worry around the GLP-1 because, God forbid, we see growth come in a little bit lower because of the shortages ending and, less runway for Hims to transact in that category. I just think that, okay, that's fine. We're probably pricing in a lot of that already at 2.5 times revenue. I mean, if you're looking at EBITDA on an out year basis, right? I think clearly this company can be very profitable. We already know that. But on my numbers, we're trading at less than 10x out year EBITDA. Maybe it's 2027, but point is, if you had sold your Amazon stock or pressed a short because you thought that the DVD business was going away, how would that have worked out for you? Right. So I think, again, when you're talking about healthcare, which is a $1 trillion category and where there's really no limit to the number of verticals that they can begin addressing on the platform. Oh, by the way, it seems like there are a lot of legal loopholes that should allow them to continue to be relevant in the GLP-1 market. Some of those as a function of their own thoughtful and strategic 503A, 503B acquisitions, right? Which I think, again, speaks to the quality of management. So it's the classic forest for the trees. It's sure there's risk but to try and boil this thesis down to will they have GLP-1s or will they not have GLP-1s, I think is idiotic.
Well, we're pushing up on the final hour of the trading day, so I want to give some time back to you, Alex. Final question, if that's okay. We have a bull case price target from Morgan Stanley of, I think, $110. We have Bank of America doubling down pretty much every week that, $21, $22 price target. You've given us some hint as to how you think about HIM's valuation, but we're trading at, I think, $28 today. We were down at 22 overnight, like 2 days ago. What is your price target on HIM?
Well, I think that they've got 2.225 million subs on the platform today. Annual ARPU per sub, $684, generating about $1.5 billion in revenue, already profitable. They think margins can go to, what they say, 20 to 30%, I think. How many people live in the US? 320 million. We've got less than 1% of the total population on board right now. Oh, and by the way, what I didn't mention either is that David Wells, who is a board director, former CFO of Netflix, he was instrumental in Netflix's expansion abroad. So he actually went and lived in the Netherlands for a full year to help set up Netflix's European business, which is a huge business for them now. And HIMS we haven't even talked about that yet for them, but international, right? So when you're at less than 1% penetrated on kind of the addressable market in the US, and you've got a guy that is on the board and with incredible expertise and experience in terms of building similar models internationally, where can it go? It can go a lot higher is the short answer. I think that 10 million subs in the fullness of maybe 4 or 5 years is not unreasonable at all. And, on that, we're thinking 750 million in ARPU, 7.5 billion in revenue, about 1.9 billion in EBITDA. If we get to 25% margin, 15x that, and plus the cash, and that's a $114 stock and a $28 billion market cap, which I think is actually low, potentially. Again, because of everything else that I laid out in terms of, so that to me is like, it's a bull case, but it's not even that much of a stretch bull case. And that's like 340% upside from here.
A few years out.
Yeah, a few years out. I don't think they're going to get there. They're not going to get there this year, obviously. But look, we saw the stock go to 70 earlier in the year. Part of that was very, it was kind of silly. But on the other hand, it's because people were doing the math, just like I am. And, it's not completely insane to think that there's that type of upside here. And it's also to say that it can happen quickly, right? When things come together and in the right market environment, it can happen quickly. Right now, we're not in that market environment anymore. We were, and now we're not. So we probably need a lot more to come together on the macro front before we revisit those highs. But, for me, the way I'm playing it is I'm taking a longer term view, looking to add on the days when it's randomly down 10%, which, as you know, we get frequently. And I'm playing the long game here, but because I think that the long game is going to be very rewarding.
This has been Alex Beinfield, founder and chief investment officer at Blue Duck Capital. Alex, thanks so much for being part of
Thank
Him's
you,
House.
Jonathan and Patrick. I really appreciate the opportunity, and I enjoy all your work and contribution to illuminating the Hims bull thesis for everybody, because I think it's a good one, and you guys do a good job of that. So thank you.
Appreciate it.